investor in China, arguing, quote, beneath negative narrative, it's actually a market that's cyclically much better positioned than the USA. He owns names like EV maker NIO and others. MSA Capital managing partner Ben Harburg joins us now to talk about all that. Ben, it's good to see you. Just first of all, address the macro picture. It's been something of a disappointing several months. People anticipated perhaps a greater growth push with the country reopening, and the markets have reflected that to a large degree.
We're not surprised by the really lagging numbers over the last 2 quarters. It was going to take a long time, both for domestic consumers to build back up their savings and feel that they could spend discretionary income, as well as global investors to trust this market again after so many lashings at the hands of regulatory interventions and technology names, the zero COVID draconian lockdowns, and just a whole slew of policies that felt like they prioritized stability over capitalism and over a free market. And so we expected a lot of turbulence in the first 2 quarters. We're starting to see some shoots of growth and improved consumer confidence out of the numbers that we saw, the likes of Alibaba and some of the numbers out of Tencent. So we're feeling a little bit more optimistic heading into Q3.
And what do you make of the current moves, both in terms of talking about stimulus and also even overnight when, they tried to defend the currency a bit after a stretch of weakness there? Are these good signs? Are we back to that playbook of, listen, you buy when China wants to stimulate, or is it a little more complicated now?
The Chinese government thought that they could kind of inorganically find their way out of this recessionary environment, that if they just reopened the market and teased stimulus, teased interest rate drops and an infrastructure investment injection, that would kind of stimulate global investor appetite to rush back into the world's second largest market. And that simply didn't happen. And so as we anticipated and projected, they are going to have to get much more active in terms of how they inject capital into the ecosystem, reduce interest rates, and buoy investor and consumer confidence that they can continue to operate as they had pre-COVID in this market.
Ben, I feel like I have to ask, I wouldn't have asked this question a few years ago, but why are you investing in China? Because foreign investors have been bailing, and I get it was always the promise of growth, but without that and the increasing geopolitical tensions and now executive orders around investment from the U.S. government, this is risky business.
It's a great question. And actually now, more than any other time, is probably a better time to be where I am and to be a participant in this market as capital flees what is undeniably the world's second largest market and still on track in many ways to be the largest across many categories. And as people walk away from the market because of kind of headline news, but without looking at the true fundamentals of the market, as people are swayed rather than by financial reasons, but by political overhang, geopolitical risk, that provides incredible arbitrage opportunities for investors like us that are sitting on the ground to understand where Washington is going with its trajectory and which companies will fall on kind of the regulatory black and gray zones there.
But the fundamentals, you point to the fundamentals. The fundamentals are that global companies are moving their supply chain out of China after building them for years and years and years. And the fundamentals are this economy has more than 20% youth unemployment, so bad that they're going to scrap reporting the number, and that the premier has to come in overnight and say, we're going to defend our growth targets. So are the fundamentals really appealing?
The scale is still there, right? I think that James Harden kind of analogy that you just flashed before the segment is indicative of that there is still huge, vast demand in China. While there are kind of headline numbers that look negative right now in the economy, particularly on the real estate front, has needed a cleanse for a long time, needed to get rid of a lot of this bad debt, a lot of this sovereign kind of SOE overhang in businesses that were government owned and racking up significant debt, still is a fundamental market in terms of the scale, in terms of about 1.4 billion people all buying at things over what homogenous kind of platforms like Alibaba and communicating over Tencent, and the types of businesses that they're building with global range, like the TikToks of the world and Sheins. This is a company and a country that is capable of tremendous growth still, and one that, as global investors free, creates significant unnecessary depression on valuations that those of us that are still here can capitalize upon.